What happens to the world's largest economy when its most critical energy lifeline is suddenly choked? The Strait of Hormuz is one of the most important choke points on Earth. It is a narrow waterway between Iran and Oman, but its impact is massive. Every day, around 20% of the world's oil passes through this single route. If this route shuts down for a long time, the effects spread instantly across the global economy. Now, focus on the United States. At first glance, the U.S. looks safe. It imports only a small share of its oil from this route, around 2.5%. But this creates a false sense of security, because the U.S. economy is deeply connected to global markets, and global markets depend heavily on oil flowing through this strait. Start with the most immediate impact: oil prices. If the Strait of Hormuz remains closed, oil supply drops sharply. Analysts estimate a loss of 13 to 14 million barrels per day. That is a massive shock. Less supply with steady demand means one thing: prices surge. In a prolonged closure, oil prices could hit $150 per barrel or higher. Now, think about what that means for the U.S. economy. Higher oil prices hit every sector. Transport costs rise, airlines pay more for fuel, trucking companies face higher expenses, shipping becomes more expensive. These costs pass directly to consumers. Fuel prices rise at the pump, household budgets tighten, spending slows. And when spending slows, economic growth weakens. Now move to inflation. Energy is a core driver of inflation. When oil prices rise, everything becomes expensive. Food prices increase due to transport and fertilizer costs, manufacturing costs go up, electricity bills rise. Even services become more expensive. Experts estimate inflation in the U.S. could rise significantly during a prolonged disruption. This creates a dangerous situation: high inflation with slow growth. This is called stagflation, and it is one of the hardest economic problems to fix. Now look at interest rates. When inflation rises, central banks react. The Federal Reserve may increase interest rates. Higher interest rates slow borrowing. Home loans become expensive, car loans become expensive, business investments drop. This slows the economy even further. Now focus on businesses. Large corporations can absorb shocks for some time, but small businesses struggle. Higher energy costs reduce profit margins. Higher borrowing costs limit expansion. Demand falls as consumers spend less. This combination leads to layoffs. Unemployment rises. Economic pressure builds from the ground up. Now move to financial markets. Stock markets react quickly to uncertainty. Energy companies may benefit in the short term, but most sectors suffer. Tech stocks fall due to reduced spending. Retail stocks fall due to weak demand. Airlines and logistics companies take heavy losses. Market volatility increases. Investor confidence drops. Now look at global trade. The Strait of Hormuz is not just about oil. It also handles a major share of liquefied natural gas and other commodities. About 1/3 of global fertilizer trade passes through this region. If supply stops, agriculture is affected. Food production declines. Food prices rise globally. The U.S. imports and exports food, so this impact comes back into the U.S. economy. Now consider supply chains. Modern economies depend on global supply chains. Disruption in one region affects production worldwide. Factories slow down due to higher input costs, delivery times increase, inventory shortages become common. This creates a ripple effect across industries. Now focus on energy independence. The U.S. produces a large amount of its own oil. This helps, but it does not isolate the country. Oil is priced globally. Even domestic oil follows global prices. So when global prices rise, U.S. prices rise too. That is the key point. The U.S. is not protected from global shocks. Now look at government response. The U.S. has strategic petroleum reserves. These reserves can release oil into the market. This helps in the short term, but it is not a long-term solution. If the strait remains closed for months, reserves will not be enough. Now consider military costs. Keeping the strait open requires military presence. Naval operations increase, defense spending rises. This puts pressure on government budgets. At the same time, tax revenues may fall due to slower growth. This widens the fiscal deficit. Now move to global economy. If the global economy slows, the U.S. slows too. Exports decline, demand from other countries falls, trade deficits shift, economic growth weakens further. Now look at historical context. The 1970s oil crisis triggered a major recession in the US. Inflation surged, growth collapsed, unemployment increased. The current situation has similarities, but the scale is larger. Global integration is deeper today. Now analyze a long-term closure scenario. If the strait remains closed for many months, oil prices stay above $120 to $150, inflation rises sharply, economic growth drops, markets remain volatile, supply chains stay disrupted. Some estimates suggest a prolonged closure could reduce global GDP by trillions of dollars. The US would feel a significant share of this impact. Now consider a key difference. The US is now a net oil exporter. This creates a mixed effect. Higher oil prices benefit US energy companies. Production becomes more profitable, exports increase. This provides some economic support, but it does not cancel the negative effects because the broader economy suffers more. Consumers pay higher prices, businesses face higher costs, growth slows overall. Now look at inequality. Economic shocks do not affect everyone equally. Low-income households suffer more. They spend a larger share on fuel and food. Price increases hit them harder. This creates social and political pressure. Now consider global power shifts. Energy crises change geopolitics. Countries look for alternative suppliers. Trade routes shift. New alliances form. For example, countries may increase imports from Russia or Africa. This changes global energy dynamics, and the US must adapt to these changes. If you want sharp, clear breakdowns of global crises, economics, and power shifts, then subscribe The Financial Story now. You get deep insights without noise, so you stay ahead of what's coming next. Now, return to the main question. What happens if the strait remains closed for a long time? The US economy faces pressure from multiple directions: energy shock, inflation spike, market instability, supply chain disruption, slower growth. This is not a single problem. It is a system-wide shock. Now, think about the timeline. Short-term closure causes panic. Medium-term closure causes inflation. Long-term closure causes structural damage. Industries adjust. Consumers change behavior. Governments shift policies. Now look at possible responses. The US may increase domestic production. It may release more strategic reserves. It may push for diplomatic solutions. It may increase military action to reopen the strait. Each option has costs. Each option carries risks. Now consider one final factor: confidence. Economic systems depend on confidence. If people believe the crisis will continue, they spend less. Businesses invest less. Markets fall. This creates a self-reinforcing slowdown. That is how recessions begin. The Strait of Hormuz is a small stretch of water, but its impact is global. If it remains closed for a long time, the shock will not stay in the Middle East. It will hit the United States, through oil, through inflation, through markets, through everyday life. The US economy is strong, but it is not immune. And in a connected world, one blocked route can shake the entire system. The real question is not whether the US will be affected. The real question is how long it can absorb the pressure before something breaks. Stay informed, because this crisis is still unfolding. So for more such information, you can follow us so that we can deliver true, accurate, and trustworthy information to you. Subscribe to The Financial Story now.